Hello, traders. My name is Matt Weller, Global Head of Research with Forex.com, and today it's my privilege to bring you a unique interview with a tremendous guest. Today, we're fortunate to have Kathryn Rooney Vera joining us. She's the Chief Strategist at StoneX Group, a leading financial services firm that provides market access and customized solutions across asset classes. It also happens to be the parent company of Forex.com. With over 22 years of experience in global economics and investment management, Kathryn is a high-frequency contributor to major media outlets, a frequent keynote speaker at conferences, and a former adjunct professor of global economics at the University of Miami. In today's interview, we'll be diving deep into the 2024 presidential election and how it could impact markets and policy moving forward. Welcome, Kathryn. Thanks for joining me.
Thank you, Matt. Pleasure to be here.
Sure. So we've known each other for at least a year here, but for the audience's benefit, can you tell us a little bit about your career path so far? What led you to become the Chief Market Strategist at StoneX, and what do you enjoy about your role?
Awesome. Yeah, I've been here for a year and 4 months. It's been a tremendous run, Matt. Before that, I was the Chief Investment Strategist at a boutique investment bank based here in Miami, and that was for 15 years. So I built the research platform there at that firm, and came here to do the same for institutional clients. Previous to my past 15-year gig, I was at Bear Stearns. At Bear Stearns, I was the fixed income strategist until the bitter end. I saw that $2 bill smack to the door when Lehman fell and Bear fell, and then JP Morgan took over Bear Stearns. And before that, I was on the buy side, so I was an investor. Talking to guys like you and I, but I was an investor at MetLife Investments. I have my master's in economics and finance from NYU. I got that while I was working at Bear Stearns, so I'm used to little sleep, which is something that I currently get now, Matt, with this job that I travel pretty much every week, and with 5 children, so it makes a very fun time in my life. And no, it's a pleasure to be here. I've loved every minute, and I look forward to the conversation with you.
Yeah, buried the lead there. 5 children is probably the majority of your time that you're not working. But we really appreciate having you here. And I wanted to just start with a very broad question about the election. As we approach this 2024 election, what are some key economic factors and market conditions that you think investors should be paying attention to? And then how does that vary relative to past elections? Because I know this one's setting up to be pretty contentious. How are you viewing it at a very high level?
This is unusual in history, Matt, in the sense that the economy and the markets specifically are roaring ahead of this election. Mm-hmm. So normally you have more volatility in the S&P 500 in the run-up, especially in the last couple of months, to a presidential election. We have not seen that. What we've seen the past few months, specifically the past 2, is a market push relentlessly higher. So that's unusual in history. The other thing that's unusual in history is the sensation of the American voting populace that the economy is not doing well. And that's because inflation is still eating into people's incomes, and they feel it at the gas pump, and they feel it at the supermarket. But at the same time, you see economic data prints showing that the labor market is roaring, showing that the economy is growing 1 full percentage point above potential. So this is an interesting combination of factors, Matt, that leads me to think that this election period, specifically the presidential election, I have a higher conviction on how the congressional turnout will be, but I'm less convicted on the presidential outcome because historic tools, both economic and when you look at market performance in the past 24 presidential elections, may not play out as one would have otherwise anticipated.
Yeah, you highlight a key one that's sticking out for me, and that's sort of this disconnect between objectively at the moment, looking at the current economic data, which I think is pretty strong. You see growth, you see a strong labor market, you see inflation coming down, versus a lot of people's perceptions and in many cases lived experiences where they're not focused on the over the last year, the 3% inflation rate. It's the cumulative effect over the last couple of years. And as you mentioned, seeing those gas prices in size 500 font on the side of the road every time they go out. So that leads into, I think, something interesting that you had done some research on, how the S&P 500 itself can be a predictor of the election. Generally, the idea is if the S&P 500 is performing strongly, that tends to benefit the party currently in power, and vice versa. If stocks are falling in the lead up to the election, that can be better for challengers. Could you talk a little bit about that research, some of the key levels to watch if you have them offhand, or just at a high level, what to watch in the next month?
Absolutely, Matt. And it's a very simple exercise, but it's interesting, I think even fascinating. And the truth is that it's been historically very accurate. Now, in economics, we have a term called ceteris paribus. That means everything else stays the same, which it never does. But you have to caveat your analyses because this is one input into many. But when you look at the past 24 presidential elections going back 100 years when the S&P started, 22 out of those 24 times, actually, I think there's 3 exceptions if I'm remembering correctly of the analysis. That's Eisenhower, Nixon, and Reagan, where this didn't work out. But the analysis is very simple. It's the 3 months prior to the presidential election date. If from the beginning of that 3 months to the end of the 3 months, the S&P is up, the incumbent wins. If the S&P is down, beginning to end in the 3 months run up to the presidential election, the challenger wins. It's that simple. So it's an interesting exercise, and the reason why it's powerful, and this is something that in a StoneX speaker series in-person event that we did 2 weeks ago in New York, the chief economist of Point 72 discussed this with me, and he said, the consumer is all important. The wealth effect is all important. So if you own stocks, even if you don't own stocks, you're feeling wealthy. You're feeling like good. So it's called the wealth effect. And if the S&P is up, people feel wealthy. If people feel wealthy, they think, you know what? Why change it? Let's just keep things as they're going, status quo. So that's kind of the general idea of the analysis. And obviously, Matt, that clearly favors the incumbent party. Now, this time is different because it's a different candidate. So I think we can't basically say Harris is going to win, but because of this, but it's an interesting input. And you asked for specific levels. I'm going to give them to you. In a piece that I published 2 weeks ago, October 1st, so actually 1 week ago, time goes by very quickly, the line in the sand for a Trump win, 3 month prior line, would be 51.86. Take it for what it is. It's a simple exercise. It's not indicative. It's just an interesting data point. But the S&P actually, Trump wins if the S&P is at or less than 51.86 at the close on November 6th. Okay. Harris wins if the S&P is at the close or above October 31st at 55.22. It's I'm not making a call here. I'm not making a call on the S&P. I'm not making a call on the presidential victor. But this is an interesting exercise going back 20 out of 24 instances. This barometer of the presidential election has been correct.
That's unreal for such a simple indicator, but I think when you explain it from a consumer sentiment perspective and the wealth effect, it makes a little bit more sense. To your point, we don't suggest political betting based on exclusively what's happening with the S&P 500, but I did think it was really interesting, and it's an inversion of how a lot of people are thinking about, if Harris wins, what does that mean for the S&P? This is kind of the opposite. It's based on what's happening with the S&P. What could that mean for politics? So that actually transitions pretty nicely into the next thing. Go ahead.
Yeah. No, you're right. I think the point you just made is so dead on, because a lot of us, what we think about and what makes intuitive sense is to say, okay, what happens if she wins? What happens if Trump wins? Where does the S&P go? Well, what about the flip? What happens in the run-up? How does that affect the outcome? Precisely.
Sure. And now I'm thinking gas prices, as we mentioned earlier, can be a big factor. You could probably build an extensive model there, but it's always important to keep in mind this is still, going back 100 years. It's still a small sample size of only 25 elections. So it's worth keeping in the back of our minds, but not something that you want to focus on exclusively. But that does transition nicely to potential market outlooks and kind of what many viewers, I'm sure, are here for. How do you view the impact on the economy and specifically on markets based under scenarios where Harris wins, where Trump wins, and whether you have a lean right now?
Well, let's get into the meat of it. I think there's, let's call it, four principal areas that I care most from a market's perspective, because my role is to advise primarily institutional clients: taxes, tariffs, regulation, and the deficit. Those are my go-to. Where do taxes go under either administration? I'm going to caveat this, Matt, because taxes can't move without congressional approval. And before we get into the juicy fun part about who wins, Harris or Trump, let's talk about the mundane. The mundane is that you need congressional approval in both branches of Congress to change tax laws. Okay, so you would need a Democratic sweep to get a 28% corporate tax rate, which is what Harris wants, or you would need a Republican sweep, meaning Donald Trump takes the House, the Senate, and the White House, to get a drop in the corporate tax rate from 21, where it currently sits, to 15, which is what Donald Trump would prefer. So my view is that, this is my conviction view, is that the House and the Senate are divided. So we get a division of power in Congress, rendering the tax question, whether it goes up, whether it goes down, futile. Now, what happens next year? Everyone's going to be talking about taxes. So yeah, corporate taxes may not go up, they may not go down, but what people are going to be talking about is the extension and the sunsetting of the Trump tax cuts. And my bet is that Harris extends them and Trump makes them permanent. So who wins here? I think the people who have enjoyed the Trump tax cuts win, because it's unlikely that a Harris administration raises taxes on people that, according to her, are enjoying them, or according to anyone, it's just the simple fact. Houses, domiciles that make 400,000 or less enjoy these tax breaks just like others. So my view is that Harris extends them for that 400K or less domiciles, households, and Trump attempts to make them permanent. Tariffs, here's the simple truth, and I'm out of consensus on this. I attended the IMF meetings in April of this year. I heard color from when our Treasury Secretary came back from China. I heard policymakers on both sides of the aisle talk about tariffs. And here's the simple truth. This is a bipartisan adoption. Everyone's on board with them. So people say Trump is anti-trade. Trump's going to jack up tariffs. Guess who kept all the Trump tariffs? Biden-Harris. So Trump installed the tariffs. These are just simple truths. Trump installed the tariffs back in 2017. Inflation barely affected, negligible impact. The markets did drop, then recovered. Biden-Harris came in, maintained all of the Trump tariffs, and added to them. So, and then when you listen to the policymakers, because of the weaponization of overcapacity, which in other words means China's creating too many goods and dumping them on the global stage, everyone's talking about penalizing China and protecting their own manufacturing. So you have Brazil already putting tariffs on Chinese EVs. Mexico's already done it. Germany's it's in the offing. The U.S. has done it. So, and one other final thing I'll talk about here is that you'll hear industrial policy. That's a euphemism for protectionism. This is my view. Take it for what it's worth. But listening to all of these conversations, industrial policy is a euphemism for protectionism. So when you hear someone say, "Yeah, I'm in favor of industrial policy," that person's in favor of either sanctions, tariffs, or another form of protection of one's own country's goods. So my view, tariffs, Harris will be modest to aggressive. Trump will be more aggressive, but tariffs are here to stay. My view is that trade war is here and it's going to stay. Regulation, I think it's very clear. Harris more, Trump less. Budget deficit, unfortunately, in my view, no improvement in either sense. No. Marginally more positive under a Trump administration, just because if we actually get this government efficiency czar, I think there could be some improvement. But the reality is that under either Republican or Democrat, we've seen no fiscal improvement since Paul Ryan made the attempt many years ago and was unsuccessful in so doing. And I'll finish with this, Matt, which is that the U.S. economy is growing above potential. We have never seen in the history of our country a fiscal deficit of 7% of GDP with an economy that's growing, not just growing, but growing.
During peacetime.
Exactly. Growing above potential. So we're in peace. The economy is growing at 3% when potential is 1.8%, and we still have a fiscal deficit that's at 7% of GDP. And I'll just add one more thing, and I do have to tap myself on the back for this one. COVID, when we had the stimuli in COVID, I said to anyone who would listen to me, these government these government transfer payments will not be taken back. They will become massive social spending, and I think that's what's occurred. And I don't expect this to come back to pre-COVID levels for the foreseeable future.
Yeah, it's an interesting policy insight for an election that seems so fraught with people so passionate on both sides that when you just take a step back and highlight some of the things that have happened, and then what I think is a very reasonable outlook for the future. You talk about, the deficit probably remaining in place, maybe tweaks around the edges. Same thing with tariffs and protectionism. That seems to be almost like a secular theme, regardless of who's in the White House. So kind of reading between the lines there, and correct me if I'm wrong, it seems like some of the biggest policies that have been put in place of late, whether under Trump or Biden, might not change and therefore might not be as dramatic of a difference as a quintessential Trump or Harris voter would have you believe.
I think that's correct, Matt. And I think what people forget is that we have historical precedent. Trump is not an unknown entity. He's always been president. Okay, so when we talk about slapping tariffs on China in this order of magnitude, we've already seen this movie. So you say you're going to do this and you do this, but you do something. So when we're talking about slapping 100% tariffs on all of these goods, well, maybe we do something, and we also have historical precedent and historical proof of what happens with those tariffs and the direct impact on inflation. There's something, but in 2017, when you look at the inflation data, yeah, we had other factors going on, but it's hard to tie one thing to the other. So I guess the bottom line is, from a tax impact, from a tariff impact, from a fiscal deficit impact, I effectively see no change, given a division in Congress, assuming that occurs.
Sure. And that'll be a key thing to watch. I think your intuition, at least at the moment, is correct that we will likely have that division regardless of who wins the presidency. But that's a good transition into, assuming we do, or on an extreme extent, even if we don't, what do you view as, in the equity market, specific sectors that might benefit from a Trump presidency versus a Harris presidency? What's the proverbial Trump trade and the Harris trade that viewers might want to keep on their radars?
Again, we have historical precedent. So what happened when Trump won back in 2016? Financials roared, industrials roared, banks did fantastic. So again, this is not an unusual thing. We have precedent, we have proof. So I don't think that we're going to get the same surge in these pro-growth sectors were Trump to win, simply because 2016 was a complete shock to everyone. It wasn't priced in. Now it is. So the Trump trade is priced in. I don't think we get a huge bump. I think we get a big bump. And this is me as an market economist, not my preference at all. So please keep that in mind. My view is that if we get a sweep, Trump taking presidency and Republican sweep in Congress, I think the markets move higher. Why do I think the markets move higher? Because then you're going to get lower taxes. And mathematically speaking, I've done this analysis, and I'm happy, Matt, to provide it to your client base if they're interested. I've done the work. So a quantitative analysis shows, ceteris paribus, everything else the same. When you take taxes lower from 21 to 15, the effective rate is lower, earnings per share are higher, the PE ratio, depending on where it sits, the S&P is generally going to be higher. So I think that if we get a Republican sweep of Congress and that of White House, I think it goes higher. If we get a Democratic sweep, I think it goes lower. And it's simply because of taxes and regulation, because that bites into the earnings that a company can keep in its pocket. It's very simple, in my opinion. So if we get a divided Congress and whoever wins, my suspicion is that the markets do not move if we get a divided Congress. Now, we haven't talked about one other possibility, which is a contested election. It's so close that we don't have a victor. Now, I think the markets drop, and I think they drop big. And my personal viewpoint is that is a buy. That's my view. I think if we don't get we don't get a decisive victor, which is absolutely the best possible scenario for everyone, a decisive victor, a very clear victor. If we don't get that, we get a contested election that's drawn out, the markets drop and you buy it. That's my view. I think that, we had this speaker series with Kellyanne Conway, the strategist actually not just the strategist, the campaign manager for Donald Trump in 2016, the first woman successful campaign manager to lead him to victory. We spoke with her for our clients, StoneX, and we spoke with James Carville, who was the campaign manager for Bill Clinton in 1992, and to this day remains the most, arguably, I don't think that controversial, but arguably the most important Democratic strategist behind the scenes in the Democratic Party. We spoke with both of them, and it was very interesting, Matt. I'll give you my number one point that I took away from Carville. I thought this was fascinating. He said there are 7 swing states, and he said it's not going to go 4-3. It's going to go 6-1. It's going to go 7-0. He thinks it's going to be decisive. I found that fascinating. He said there's 7 swing states, to which Kellyanne Conway, they have a really nice rapport, very civil, very nice. To which Kellyanne Conway interjected, there's seven swing states, but there's only 15 to 20 counties that will decide this election. I thought that was interesting. 15 to 20 counties will decide this election. And so I thought that was great. He thinks that the swing states are either going to go all in on Harris or all in on Trump. And honestly, I think that's the best outcome for our country and for the markets.
Yeah, that's a good point, is that the uncertainty, if we're in another situation like we were in 2020 or hopefully not, but even worse, that I could see being at least a short-term negative. But in that case, it's almost like, if there's nuclear threat, that's when you buy the market, because if we don't all pull together and get it straightened out, then it doesn't matter either way. So we'll maybe transition to a little bit happier topics, but I think that is a good perspective there in terms of different scenarios that could play out. You've already touched on a lot of the policy implications that I wanted to discuss: tariffs, taxes, I think being the big ones. One I did want to touch on, just because you'd have to be living under a rock not to notice it in the stock market, is artificial intelligence. Any regulation there, the outlook under different election scenarios, or if you think it's pretty similar, just the outlook moving forward for whether this AI trade can continue to drive markets in the months and years to come.
Yes, that's a very good question. I'm not sure the presidential ramifications on that, although I would say that the presidential ramification on inflation and interest rates could indirectly or would indirectly affect AI, because AI and technology sector in general is interest rate sensitive as a sector. But more structurally, which I think is where the question is coming from, is are we at a mature phase, or is there more upside? My view is that I think we're at a mature phase. I think we've seen the bulk of the appreciation. I think now is the time to play the second derivatives of the AI trade, because as I say, we are in a mature phase of AI, and I think the market's going to be more selective with the companies that are innovating and delivering and actually deploying these heightened productivity measures, which is what these AI companies have birthed. So I think we're going to have to be more selective. And my top pick coming into this year, and has actually been at certain points of the past couple of months, the top performing sector, beating tech, has been utilities. And I selected utilities going into this year for 3 reasons. One, because they were so destroyed last year, so you get that mean reversion. 2, because, well, let's put two reasons. The second reason is divided into 2. 1, because of last year's devastation. This year, I thought there would be a mean reversion. And 2, utilities is a natural second derivative to the AI trade. It's a natural second derivative. And I break that into 2 reasons. One is because AI requires energy. ChatGPT search has orders of magnitude more energy requirements than a simple Google search. And 2, because utilities, the second part of that reason is that utilities is a lovely defensive. It's great. So you're kind of playing both sides of the coin. I loved it because, and I still like it. I think it's just played out already. So I've been taking gains, and that's a publication I'm going to be putting out here shortly. I would be taking gains in our utilities call. It's up 30% year to date. And the reason I liked it and why it outperformed is because, yes, it's a second derivative on AI, but it's also a defensive. So you have a natural built-in hedge there. Utilities historically outperforms in recession and in economic downturn. It's high dividend and it's a bond proxy. So, I mean, what's not to love? Except that it's like the least sexy sector. And when I put on the call at the beginning of this year, people were like yawning. But now they're not. Now they're not because it's up 30%. And in the past month, it actually was beating tech year to date. So I think that now's the time probably to take gains in utilities and potentially rotate into other underloved sectors, and sectors that can benefit from a mature phase of AI, such as industrial real estate. AI needs warehouses. Go long industrial real estate. Makes sense to me. And the other thing I think is healthcare. It's a nice defensive. It's massively underperformed this year. So I'm going to go out on a limb and say, protect your gains next year. I love protecting gains. I think it's a judicious strategy. I think the markets are woefully underpricing risk. Woefully. I think the euphoria, the complacency is insane. That's my personal opinion, if I can be very real. I think we need to protect positions in tech with very cheap put options. I think we need to have short duration treasury notes. I think we need to have cash. I think you need to hold on to your gold positions. And I think we need to buy into the defensive sectors, such as healthcare.
It's a good reminder at this time, too, just as you know, markets have gone almost straight up. That AI trade has been a big driver at a high level, but coming into the election, such an emotionally fraught circumstance, if people, in my experience, have a tendency to overmix their political views with their market views. And if their preferred candidate wins, markets way up, that's where they can get euphoric. But there still are those risks to be aware of. And I think you highlighted some good hedges, if you will, or at least cheap protection that can help in that scenario, regardless of how traders look to put those on, whether it's the futures market, spot. There's a number of ways to realize them, but just being aware that markets don't always go straight up forever. It seems obvious, but this is the type of environment where people can forget it.
I couldn't agree more with you, Matt. And it's kind of that trend bias or that anchor bias that we all have, and we need to be very cautious of. And I'll also compliment your statement, which is we need to divorce our own emotions from our money. So protect your money. Go vote. Watch the news if you like it. Enjoy it. It's kind of, my mother used to call it glorified gossip. Politics is glorified gossip. But at the end of the day, you're protecting your wealth. You're protecting your patrimony for your children. So try to be agnostic and try to protect your gains and not get greedy. Because I think a lot of retail investors, what we tend to do is to when the markets are going up and they've already gone up, say, oh man, we need to get in. That's not the time, to be chasing the market. That's the time when everyone's greedy to get prudent, judicious, and protect your gains. And one final thing, which I think is an important thing to remind individual investors, is when markets are very hot, when risk appetite is robust, when markets don't seem to consider or talk about or internalize potential wars in the Middle East, a potential resurgence in inflation, potential recession, which is an innate and inherent part of the economic cycle. We forget that because we haven't had one in many years. That's when protection's cheap. Protection is not cheap when you get a war. Protection is not cheap if the Fed has to hike rates because inflation resurged. Protection that gets really pricey. So let's not be greedy. What we want to do is when the VIX, the volatility index, collapses 12, 13, 14 index level, that's when you buy the put options. That's when you protect your technology positions. That's when you protect your S&P. That's when you potentially buy some of those underloved and underperforming defensive sectors. It just makes sense to me. It's a little counter our emotions, but like I said, we have to be agnostic and we have to protect our money.
Absolutely. I think that's great perspective. And that kind of transitions to me into another area which I think is seen as risk positive and perhaps a cushion if anything goes wrong. That would be Fed policy. Of course, the Federal Reserve has started cutting interest rates. The markets are expecting quite a few more interest rate cuts over the next year by the end of 2025, looking to get, or at least traders expect interest rates to drop toward 3%. What's your outlook for Fed policy? Is there any impact from the election? And I also thought, I don't know if you have it to hand, but you did an interesting study on what happens after the first Fed cut in a rate cutting cycle, based on whether it's sort of what kind of cut it is. If it's an emergency cut to offset a recession, that's had different outcomes for the market than otherwise. So
it
do you have anything
has.
there you can share?
Absolutely has. Now, the recession risk doesn't happen when the Fed is hiking. The real risk of recession, historically speaking, when you look over the past decades in the US economy and you overlay that with monetary policy, the real risk of recession occurs when the Fed starts cutting. The question is, why is the Fed cutting? And we don't know that in the moment. We know that later. But the real risk for the next 12 months is when the Fed starts cutting, when the yield curve is negative and it goes positive. So the yield curve has been negative for more than 3 years. It's now positive. The Fed is cutting rates. It's been hiking rates. Now is the vulnerable time. And we won't know until later if the Fed is cutting and the yield curve is uninverting, whether it's because of inflation receding and being so healthy, or if it's because the labor market has rolled over and we're on the cusp of recession. It's that simple. When you look back over history, 43% of the time that the Fed has cut rates, 43%, that's not a small number. When the Fed starts a rate cutting cycle over the next 12 months, 43% of the time, in the past 7 episodes, I forgot to say that, in the past 7 times that the Fed has started cutting, 43% of those times, the US economy goes into recession over the next 12 months. 43%. So yes, the odds are in your favor. Let's call it 60% the economy doesn't go into recession over the next 12 months. But 40% is not something to sneeze at. So I'm cautious, I'm cautious. I'm not saying sell your equities. I'm not. Because here's the simple truth. If we avoid recession, the S&P this is the analysis that you're alluding to that I did. The S&P goes up double digits. So if we effectively avoid a recession, the S&P goes up, historically speaking, another double digits, 10, 15%, okay? If the economy goes into recession, it's the complete flip, as one could logically imply from this. But like I say, this is not a small number. And actually, it's consistent with my view, which is there's a 40% chance of recession. I think it's higher than consensus, and that aligns with the risk historically of some 40%. So if we avoid recession, S&P goes up double digits. If we go into recession, it's the complete flip. So I think the odds favor at least taking out some protection and protecting your portfolio.
Yeah, it seems to be a theme throughout this conversation. I did want to touch on the Forex market. I'm not sure if you have any strong views, but how, especially with the combination of tariffs, we have loosening monetary policy, your expectation and mine as well, is continued loose fiscal policy. How do you digest that cocktail of different factors? What could it mean for the US dollar, and whether there are any other currencies you're watching closely?
Structurally, which means over the next 5 years or so, which is not most of our profile, but structurally the dollar should go weaker, and it should go weaker because of economic principles, which are current account deficit and fiscal deficit, and a Fed that's cutting rates. That's a structural view. My near-term view, my tactical view, is for dollar to be stronger. The main driver of FX, and push back if you disagree, but I suspect we're on the same page, is interest rate differentials. That's the main driver. We can talk about the fiscal deficit. We can talk about the current account deficit. We can talk about nominal growth differentials between competing countries, Europe, US, Japan, US. Fine. But interest rate differentials are what count. And my view is that the Fed is not going to be able to cut to the order of magnitude that the markets have priced in. What is fully priced in right now in the markets, Matt? The perfect landing. Not soft landing, not no landing, a perfect landing. That's what's priced in. So if we get anything other than a perfect landing, which is a no landing means the economy continues to grow at such robust rates that we risk inflation coming back, and God forbid the Fed has to hike rates. rather than cut the 300 that the markets have already priced in. So that would be bad for risk assets. And I think we alluded to this before, but there's also other inflation risks on the horizon. War, oil prices, a closure, even partial, of the Strait of Hormuz because of conflagration with Iran. Protectionism, i.e. industrial policy, whole-scale adopted, not even bipartisan, but globally. Trump is inflationary. We're already, and it's not because of tariffs. He's inflationary because of the growth potential. So you unlock animal spirits, you unlock them by, cutting corporate tax rates, cutting individual tax rates, lowering regulation. What does that do? It's good because people spend their money, invest, companies invest, they pay back money they're short. All that sounds awesome. However, the flip side to that is it doesn't help get inflation down to the 2% target. So if we get a Republican sweep, which is not my base case, could happen, anything could happen. We know that polls are historically very inaccurate, so who knows? Actually, Kellyanne Conway said this. She said, the hidden Trump voter still exists. And what she said, and actually James Carville agreed to this. And if your clients are interested in this, I did publish a note with my takeaways, and I'm happy to share this. But what James Carville said is that, yes, it's true. The Republican base has widened. So what does that mean? It means that, and James Carville said this, the Republican Party is no longer just, the wealthy demographic. It's the working class. It's growing with minority support. And there's been a 500% increase in support since 2020 with minorities for Trump. So if Kellyanne said this, if a third of those people come out to vote for Trump, it's a win. It's an easy win. So really, I don't think we know who's going to win. But I can tell you, if there's a Republican sweep, it's probably going to be viewed as both great for markets in the near term, but inflationary later on down the line. And my point here is that if inflation resurges or doesn't continue to come down, the Fed is not going to be able to cut 300 basis points. The Fed may be able to get from, we topped out at 5.25, may be able to get to 4, maybe able to get to 3.5, but that's a far cry from the neutral, long-term neutral rate, which the Fed thinks is 2.5%. So that keeps long-winded. Excuse me for being long-winded. I hope I didn't lose anyone, but the long-winded answer here is that maintains the interest rate differentials favoring the dollar. So you get a Fed that doesn't cut as much. Europe is cutting. Emerging markets are cutting because they've conquered inflation. We have not yet conquered inflation. So you keep inflation rate differentials. If the U.S. avoids recession, we're growing at a faster pace than any of our, let's call it competition, because effectively that's what it is. Europe and Japan, we're growing faster. And we're the place of we're the safe haven. So if there's a war in the Middle East, if China invades Taiwan, if there's any black swan event, which really wouldn't be a black swan because we're kind of all expecting it could happen. Black swan is by definition something out of the blue that you don't expect. What happens if the U.S. is downgraded? What happens? Money globally flocks to the U.S. It buys treasuries. It buys the dollar. So my firm bet is the dollar sees continued strength over the course of the next 6 to 12 months, even though structurally over time, we should see some headwinds.
Yeah, absolutely. And that's exactly the way I look at the Forex market too, is through those relative interest rate differentials. And we didn't chat about this beforehand, but my view is similar. Actually, it has been throughout this year. So it hasn't been, maybe I was early, not wrong, but the US economy is larger, more diverse, more dynamic than many of these other currencies. And the central banks were projected in many cases to cut interest rates by less than the US. Maybe we're starting to reach a turning point as we're recording this. We just had a really strong US jobs report that's calling into question some of the aggressive interest rate cuts in 2025. I think that'll be a key story to watch for Forex traders next year.
If I can jump in, because you're the expert on Forex and you've done a lot of good work on it and you've gotten a lot of calls, right? Do you see any additional drivers to those that I've already named And what is your view, Matt, if I can ask, with regard to dollar strength, yen strength, and emerging market currencies? Let's call it over the near term, 3 to 6 months.
In the near term, I see, and I always like to think about it. This has been kind of permeating your talk as well. I think of it as a range of outcomes and different scenarios that could play out. And to your point, I think a lot of them favor the U.S. We have the geopolitical tensions. I think that's always, it's, you can always say that and it sounds smart, but I don't think we've ever had as many hot spots. I'm sure we have, but not recently had spots that are actively at risk of really boiling over between obviously Ukraine ongoing, in the Middle East. We have the China-Taiwan tensions. I think all of those are perhaps underappreciated as, again, tail risk scenarios, but then just fundamentally from the economy, we see the U.S. economy continuing to grow strongly. We see the labor market hang in there for the minute. Inflation is low. So that's what's giving the Fed the opportunity to cut rates short term. But it's hard for me to envision a scenario where, if the U.S. slows down, the Fed has to cut more aggressively. On one side of the coin, that's negative for the U.S. dollar. But I don't see a scenario there where Europe or emerging markets are continuing to power ahead while the U.S. slows down in our current environment. So that's been a take I've had all year. Take it for what it's worth. It hasn't necessarily played out perfectly this year, but I do think the range of outcomes is supportive for the U.S. dollar, at least in the very short term.
And Matt, if I can add one other point, which I think we touched on, and you just mentioned it, which is the range of outcomes and the potential for tensions to boil up in the Middle East and China, is this. I don't know if you agree, but I find it remarkable that we're such a Teflon market that no one cares. It's just, I find it remarkable that inflation expectations are so remarkably well anchored when you have escalation in the war in the Middle East. You have pretty significant stimulus out of China. You have global central banks easing, which has a positive impact on manufacturing and industrial sectors globally, meaning that they're going to build up and get stronger, which is inflationary. Everything I just said is inflationary. All of this should threaten inflation expectations, but it's not. And so my view, and I think this could be relevant to your client base because you're Forex.com and you do a lot of futures and hedging. I think that we need to hedge against the potential for inflation risk. I'm just looking at my publication here on this. You can do commodity position, you can do special calls on oil, protective hedges on high flying equities. And the trade, in my opinion, is to own optionality to crude upside, to crude oil upside, and downside protection to markets. So that means buying calls on oil, protecting your S&P, protecting your tech. I've already mentioned those two. Holding gold, our long gold call. So utilities was our top call. Gold was another top call. Both have done very, very well. We've had some bad calls as well, but those were our top performing calls. And I also like, Matt, diversifying with commodities. And I chatted with at StoneX, we have our chief commodities economist, Arlen Suderman. I chatted with him, and he agrees. Broaden your exposure to metals, agriculture, energy, short duration. These are ways to play the contrarian view, not just to be contrarian, but when you see this broad range of outcomes that you alluded to, and you consider inflation expectations and how low they are, it just tells me that there is so much potential for upside were we to get renewed an enforcement of sanctions on Iran. Remember, we have sanctions on Iran. They're just not enforced. So if Trump gets in, dollars to donuts, those sanctions are going to be enforced. Middle East tensions, they're going to simmer, if not get worse. China's military posturing. There's been an aggressive push against Taiwan. The Russia-Ukraine conflict. There's just so much on the horizon, boiling and simmering, that I find it remarkable. I really do, and I think there's opportunities for a savvy investor to hedge himself or herself right now.
The one that sticks out to me is you kind of led with oil. Historically, spikes in oil prices have been a big catalyst for recessions. Now, we haven't experienced that as much lately. You could argue in 2008, but looking over the course of the last 70 years of stock market history, I've always found that the energy sector can be, a lot of people think of it as pro-cyclical. When people have jobs, they're driving to work, they're consuming more oil, they're building more stuff, and there is an element of that. But also, it can serve as a clear hedge to the extent that spikes in oil prices, which is not, well, we are kind of seeing it in the very short term, but from a broader perspective, we haven't seen. If some of those geopolitical tensions boil over, that could lead to a spike in oil prices, and in that way, the energy sector can actually be counter-cyclical, or be one of the few sectors that outperforms when the rest of the stock market is struggling due to that specific kind of recession that I think isn't really on a lot of people's radars. So it's not something I'm calling for, but again, just understanding those range of outcomes and how different investments and aspects of the market can perform, I think, is something that our clients should be thinking through closely.
I agree, Matt. And I think that the fact that you're bringing that up when others don't is valuable to our clients, because, thinking outside of what everyone else is saying and providing those insights, I think is what people want to hear. And I'll add one quantitative measure to what you just said, which is that when you look at the standard deviations, which is how the probability that something can move over time. So one standard deviation up move in the price of oil over the course of 1 year, one standard deviation, not two, not three, one. So 3 is unusual. 3 standard deviations, unusual. Breaking 3 is a historical anomaly. But one standard deviation is the 35% increase in oil. That equates to a 1 to 1.5 percentage point increase in headline CPI versus the previous headline CPI year over year. Mm-hmm. So currently we have headline CPI running at 2.5%. A 35% increase in oil price for the next 12 months would take CPI close to 4%. So an increase of that magnitude will put WTI, and I'm not calling for this, I'm putting it on the table because there's a lot of stuff that could go down, would put WTI near $95 a barrel. And so that's when guys are going to start talking about stagflation, which is high inflation rates and slower growth. And there's a high correlation when you look between the 1 year ahead inflation expectations and the current oil price. And that sets up the potential for inflation to surprise to the upside. And again, we have all of this, these analyses and these charts, and I'm happy to share them with you and your client base. But I think it's interesting and something to talk about when others are not.
Absolutely. Yep. And that's the entire purpose of this chat here. Kathryn, you've been very generous with your time. I appreciate it. I do want to give you a chance to mention any upcoming research you have, how people can follow you and stay in touch with what you're doing, because I'm sure they're going to want to after this interview.
Thank you so much. It's a real pleasure to talk with you, Matt. I enjoy these substantive conversations with pretty informed people like you. So we do have quite a bit on the docket. My next piece that's coming out is on Japan. In our team, we listened to the former Bank of Japan Governor Kuroda a couple weeks ago in New York. We have those notes coming up, and I think they're particularly interesting because one of the takeaways from Kuroda was that he sees the neutral rate at 1% to 2%, which means that there's a lot more upside to the Japanese yen. The yen is currently undervalued. And if they actually take the interest rate in Japan that much higher, which is not going to happen in the near term, but just the simple fact that he said that it could be 1% to 2%, I think is really meaningful. So we have that on the docket. Then we also have a piece coming up on equities, highlighting our strong utilities call, closing that out and looking forward to 2025 with our expectations therein. And then coming up early next year, we have our 2025 piece, which is going to highlight what happened in 2024 and what we expect for the remaining or for the year that comes up. And I like that because it's going to be post-election, so we're going to have a better sense for where the economy could potentially move given the outcomes from Congress and the outcomes from the presidential election. And yes, please do, if you like my take, follow me on Twitter. My handle is @Rooney Vera, and on LinkedIn as well. Same thing. But a pleasure to speak with you, and thank you very much for the opportunity.
Fantastic. Thank you, Kathryn, for a wide-ranging overview of the potential market impact of the 2024 election. And I think we got even beyond the syllabus, if you will, talking about some broader topics to carry over into the coming years. If you enjoyed today's conversation, be sure to like this video, subscribe to our channel for more market analysis. Thanks to everyone for viewing. Best of luck for your trading throughout this election and beyond. Thank you.
Thank you.